Hello and welcome to DigFin VOX, Voices in Digital Finance. I'm your host, Jame DiBiasio. If you enjoy the program, give us a like, subscribe, let the algorithm know. My guest today is Bertrand Billon, founder and CEO of iLex, a Singapore-based fintech focused on the digitization of loan markets. We spoke about changes in regulation and market habits that are driving a move toward digitization and how much has yet to be done. Bertrand Billon, welcome to DigFin VOX.
Good afternoon, Jame. Thanks for inviting.
My pleasure, Bertrand. I've been looking forward to having this conversation. I've been sort of keeping an eye on iLex for a number of years, and haven't really had the chance to connect with you because of no traveling during COVID and so on. So keen to speak with you. You're building a platform to digitize a marketplace for bank syndicated loans and private debt. And you've recently completed a fundraise. So before we get into that, just tell us very briefly about your background, Bertrand, and how you came to be the founder of iLex.
Yeah, sure. Thanks. My name is Bertrand Billon. I'm French, as you can hear. I've been in Asia for about 15 years now, working in Europe, in Asia, on capital markets, in the consulting industry, and as well into the investment banking industry as CFO and CEO roles. I'm married. I have two kids, love sports and traveling. And so I came to create iLex 3 years ago. That was my second venture. And so the first one, it was in consulting, quite successful business that we exited in 2018. So that's about me. And started iLex 3 years ago on the premises that the loan space was going digital.
So Bertrand, why haven't loans been digitized before?
Well, that's one of the business in the banks that was mostly, buy and hold. You see it on your balance sheet. So there was no real intention to sell loans. You were just lending money to your borrowers. And then came GFC in 2008, where banks had to change the way they run their business in the loan space because of capital requirements, Basel II requirements. And so they had to move to what we call an originate to distribute model, where they need to sell loans. Hence the syndication, secondary markets. And so that was a little bit the last frontier in capital markets, where we've seen since the emergence of new players like private debt funds, asset managers, insurers coming into the market. So that's the rationale behind the need for a market infrastructure, a marketplace where all these new players and historical players can gather. And they need solutions to communicate, to trade loans, to book their loans. And that was mostly done on Excel and emails for years. So that's the rationale. There was a lack of investment in the industry.
So we have equities, obviously, is super simple. You go to a stock exchange, everything in that, at least in that geography, is there. And there's lots of standardized ways to trade, see the prices, etc. Bonds have gone electronic. It's still sort of a work in progress, but and obviously an individual bond has its own unique securities, but nonetheless, it's a publicly traded instrument. Loans, though, they're different, right? I mean, we're talking about bilateral, usually, instruments. There might be some NDAs or some sort of covenants in these. They can be quite complex and idiosyncratic. So what do you need to accommodate that idiosyncrasy in these instruments?
That's true. I mean, bonds is probably halfway, but that's a good benchmark for us because it's the same product at the end of the day. It's a venture. Yeah. And so one is public, one is private. One of the keys really to mimic the specificities of the loan market in our platform. So meaning that you don't trade loans on prices. You need to trade by invitations. There are protocols like price discovery, investor discovery, where it's very specific. And then you need to pay more particular attention at data models because they are more complex. As you mentioned, the description of a loan contract or a credit agreement is much more complex than a security. But that's not preventing us from progressing because what you need to trade a loan is only a small chunk of the credit agreement. Many other things are more legals and would be the same for like a bond where many of the things are not traded. So it's not really a barrier. We would like to see a bit more of standardizations. The most liquid loans are typically term loan Bs in the US where you have more standardization in documentation. So we hope we can see more of this, and we contribute to that by working on common standards with our partners in terms of loan description, static data, and other things like this.
Can you give me a sense of what liquidity is like? So if I talk to people on trading desk in traditional capital markets, public securities, liquidity is, aside from maybe price and valuation, liquidity is kind of like the be all end all, I think. But loans must be very difficult to create that kind of liquidity. I mean, traditionally, the secondary market for loans, right, you needed a bank to go out and syndicate a specific deal to specific people. Is your platform able to create liquidity that did not exist before in this industry?
Yeah, exactly. I mean, one of the key for platforms, not only iLex, other platform is to open up the market a bit more and make sure the assets can rotate more easily. So what we call about asset velocity. Just to give you a few numbers, new issuance in loans every year in syndicated loans, I mean, things which get distributed is roughly $6 trillion. Some liquid loans like leverage loans trade in the secondary market around $1 trillion a year, especially in the US and Europe. And we estimate that other type of loans trade around 1 trillion as well in the secondary market, but it is more under the radar and on a over-the-counter basis. But this is growing because of these new regulations, the intention from very large banks to grow their advisory loan business and really manage their balance sheet much more actively.
Mm-hmm. The other aspect that we're seeing, I guess, is a complexity in this market is because of those regulations that you cited after the global financial crisis, the rise of non-bank participants, right? So particularly private equity, right? Private equity or private capital firms have become huge issuers of, or facilitators of debt issuance. They themselves are, that seems to be where the people can take risk. They can do more, it seems, than what banks can do. But a lot of that arose in in the previous era that has just ended of low or zero interest rates. Now we have an interest rate change. Is that putting in peril some of these business models that I guess implicitly would be required for you to be a success? I mean, you need more of these players to be growing their business. Is this a good time to be launching this kind of platform, or is this going to be a headwind?
No, it's really in our favor, in fact, because when you think of bonds, the volatility of interest rate is a big problem because it's a lot of mark-to-market, fixed interest rate. The loan space is more trading credit spread. And so it's more about credit. These are usually floating rates, reference rates. So usually in times of high interest rate, that can be in favor of loans. We see clearly the private debt market continue to grow. It's still a small chunk of the overall market, about $1 trillion as well of asset under management for the very large private debt funds, the like of Aris, Apollo, KKR, and others. They are very active into the leverage loans, so acquisition finance loans, because that meets their investment criteria. And these are the loans that are most liquid. They are traded by CLOs where they actively manage positions. But we see as well growth in other loan instruments like project finance, infrastructure, where there is a strong demand for what we call real asset financing, ESG or sustainable loans. So it's really another aspect or part of the market, though it's growing fast, and there is a lot of demand from institutional investors.
What we started to talk about the financial crisis of 2008. That was obviously where you had securitization run amok in US, particularly in US housing loans. If you digitize this space to create a marketplace, for better or for worse, what kind of, does that create different ways for securitization? Does it create new areas of liquidity? Could it potentially create new risk where it becomes much easier to perhaps to transfer these things? Yeah, just curious.
Yeah, you're right. That's a very, very good question. Historically, you have three ways of managing your balance sheets. One is insurance, credit insurance, which is still working. Securitization, which has dropped, but it's coming back. And then secondary loan market. Okay, so basically just going into the market. So we are more on the third one. But we are exploring with some partners the potential of digital assets and digital loans to tokenize very large syndicated loans more effectively, or private debt instruments. There are lots of barriers to that, but that would facilitate, I would say, the slicing of loans and the incorporation into, debt strategies for funds. So there is a potential. Securitization is very expensive, very complex, especially in the loans that we trade, which are investment grade and very, very large loans. Like we talk of loans of $100 million and above. So very different from the RMBS or other type of securitization.
To what extent, to drive liquidity on your platform, do you also need there to be other types of actors that may not have been there before because there wasn't a digital marketplace? So I'm thinking in the bonds world, you've got credit rating agencies, right? And you've got the big three, and everybody relies on them to provide some sort of credit rating to those instruments. In the loans world, is there anything like that, or do you need to see the rise of these kinds of other, could be fintechs or traditionals, to help create that ecosystem to build your own business?
Yes, that's exactly what we try to do. We try to gather, people who are really specialists in the loan space, build that ecosystem. We are really open architecture at iLex. So we are connecting with data providers, the like of Refinitiv, which is one of the leaders in the loan space for new issuances. We work with S&P Global for ratings, for pricing data. So there are already providers, but we are trying to gather and aggregate all this information in one platform. And then, of course, we need to collaborate with people who are more on the pre-trade or post-trade services. So the like of, booking or agency systems or origination systems. So we have a number of partnerships in place. Because we don't intend to digitize everything, it's not possible, but just to work on building better market infrastructure for the future.
Yeah. And how much of that exists today, and how much of it is stuff that you're just thinking, okay, this is what we're going to need?
Oh, the platform is already up and running, and we have about close to 300 financial institutions using it today in APAC and in Europe. So it's already in use. It's already quite rich, functionally speaking. I mean, we do primary, we do secondary, we do kind of CRM or investor intel, market analytics. Everything is there. We are expanding the product in portfolio management, what we call business activity monitoring. So a lot of new features. We really believe in the power of communications as well, like voice over IP, all these VC conferencing, because loan is a private market. So very exciting.
So you have to create sort of like safe deal rooms and that kind of thing.
Yes, exactly. So that includes like data rooms and the whole value chain of distribution from listing assets, what we call listing or creating assets on the platform, till the closing and the settlement of the trades. So that's the strength of iLex, is the only today all-in platform where you can really do primary, secondary in all geographies, and really have a model which is quite unique in this kind of SaaS model where we implement at banks and really support the integration of iLex within their day-to-day processes. So it's not like a one-off exchange where you do one trade. It's really a tool meant for loan professionals to manage their loan business day to day.
Yeah. What's the difference of doing this in, let's say, Europe/Asia versus I think you have some competitors in the United States. Is there a different market structure in the US that makes that a sort of a separate pool, a separate ecosystem, or Is it just coincidental that you happen to be here and some other players in the digital space are over there, and it doesn't really matter?
Yeah, I mean, that was a choice to start in Asia because first the competition was less and it was really nascent. And for us, it was much more easy to start working with different players in the region from Japan, Australia, Singapore, and European banks. The US market is very competitive and it's really concentrated on a number of very, very large players, of course. It's much more a level loan market and a market which is driven by the funds, the very large funds that we've mentioned. So there is there are a few platforms looking more at the trading on prices of CLOs and level loans, but which is fairly different from what we do. The difference after is that there is a level of sophistication or maturity of the market, which is fairly different as well from one region to another. There are less capital constraints in Asia, so it's probably a bit slower in terms of adopting originate to distribute models, but we see pockets of liquidity emerging and new players across the region. And of course, our presence in Europe is growing very fast with our European clients in the UK already, in France, in Spain. We are opening up Italy, Germany. So it's really growing fast. There is a strong demand for digitization right now because banks need to restore profitability and be more efficient in the way they process their loan business.
What's for you, how do you solve that chicken and egg problem when you're trying to, you enter a new market, or perhaps you enter a new capital market segment? Do you get this thing running by getting the big funds, the private equity players to come first, or do you have to get the banks on first? You know, how do you get that flywheel moving?
That's the whole things about marketplaces, and whether it be it like in capital markets or anything of marketplace, you have a lot of chicken and eggs issues to solve. Like you need buyers and sellers, or sellers and buyers, and you need products as well, which is very important. So the way we've looked at it is that we've partnered with large sell-side banks because they are the one issuing loans and managing, you know, the market making a little bit the loan market. So our sales team and our client team is two-sided. I mean, one is looking after our large sell-side clients and really working with them on rolling out the platform on their different loan businesses. And then we have a team which is more looking to acquire the smaller banks and on the buyer side at the same time. So that's what we've done fairly well, pretty well in the last 3 years, because I think this is quite unique to have so many market participants in such a small period of time. Onboarding banks is always quite painful. It's a long process, and we've been pretty good at this, and so we are very happy with the results so far. But we still want to grow that network and bring it to the kind of 1,000+ organization very soon.
Yeah. Can you give us some insight into the numbers, like the number of deals or volumes of deals? You know, what kind of insight can you give us into how the business is evolved?
Yeah, just to give you an idea, last year we managed about 300 deals in APAC. So that's a mix of primary and secondaries, which is a good start, I would say, because there are not like thousands of deals every year in the secondary market in Asia. So a meaningful chunk or market share last year, but we really want to grow that secondary in Europe and in Asia this year, and augment our presence and increase our presence in the primary market, especially on the real asset financing that I mentioned earlier, like things which are more private credit type of loans. So yeah, so about $10 billion last year, 10+, and we hope to continue to grow. We have very large players coming on board this quarter and next quarter in Europe and in Asia. So I think that by the end of the year, we can count of roughly having 25 of top 50 book runners in our markets on the platform. So, and to see the volumes grow accordingly.
Yeah. How do you see the digitization side versus the traditional, I guess, I don't know what the word is, the traditional syndication process? Do you see digitization displacing that, or is it more for new issuance, new deals that get originated to come into your platform? What's the the relative size of the digital side versus the syndicated side, and
I would not
compete with each other, or is it a different type of business?
I mean, I would really distinguish the digital assets, which is for probably 5-10 years down the line, which is something that we need to work on, but it's not mature. So when we say digitization of the loan space, really means digitizing the process, the interactions between market participants, and creating connections between all these participants to create transparency on the market, some more liquidity, and most importantly, more efficiencies in the process. So that's what we mean by digitization. It's a transformational digitization of the market. And
let me just, okay, so I wasn't clear in my question, so let me rephrase. Your 10 billion volume figure that you hope to reach by the end of the year, Bertrand, how does that compare in terms of size of the overall syndicated loan marketplace in Asia and Europe? And are you, give us that context. So is 10 billion like amazing, or is it like
it's a very small start. I mean, it's a long process to get the whole market, to be digitized. So I mentioned, if you're seeing that the loan market every year is probably about $7-8 trillion, so that's a very small share. But we believe that we will grow that. We will never reach 100%. I mean, if you look at the bond space, after 15 years, they are roughly at 40-50% of digitization or electronification.
Electronic trading, yeah. Mm-hmm.
Yeah, so that's it's really working with our clients to make this happen. We believe that working with the large sell-side banks is helpful to educate the markets. There is a lot of change management to be done to understand the way it works on the platform versus analog. And so that's what we do every day. It's really spending time with market participants and explaining what's the new process.
Is there a point at which you mentioned that you start off in Asia, at least in places like Australia, Japan, Singapore, where you're based? So the more mature markets, do you have, is there a scope to go into the emerging markets here?
So the way the syndicated market works is that some markets are very local for some constraints on currency exchange or limitations. So many markets are local, but you would still have the financing of some project of some very large companies in Southeast Asia, in India, across the region, which are syndicated from Singapore, from Hong Kong, from Sydney. So that's the way it works. So you have two markets. One is the international market, which is more liquid, more global. And then you would have the more local market, which tends to be local players. So we focus first on the international or regional market, but we have projects with some players to establish local marketplaces as well.
Okay. You recently completed a $4.5 million raise. Tell us a little bit about what funding conditions are like right now, because obviously for fintechs, it's been a tough environment, but you were still able to get that away. Did you have to sacrifice something in terms of the covenants to get the money, or was it easy? Or what's been your experience when it comes to the funding side?
Yeah, I mean, it's not an easy exercise for two reasons. First, iLex operates in a market which is not that where VCs are not very familiar with the syndicated market. They would know equities, they would know bonds, and they would probably know much more about payments, BNPL, all these topics. So first, we need to explain what we do, and there are only a handful of funds that can look into our investment thesis. But so that's what happened is that we were in talks for already several months with a few investors that really wants to invest into capital markets and loan capital markets or debt capital markets. So they were very sharp in the dynamics of our market and the need for and the potential of this market, which is huge when you think about it. There are probably more than 100 bond platforms today for corporate bonds, and loans is equivalent in terms of size of market. So we closed in December. Of course, we were very happy to close because the market was quite tough, and the conditions in the market were quite difficult. So that gives us more visibility on our strategy. We've been always cautious about the way we spend our money, trying to be profitable as soon as we can, or at least break even. So yes,
are you profitable now, or is that?
Oh no, it's something planned for 2024. So that's progressing well, but we still need to invest in client acquisition, in new geographies, new features. So the money is really meant to accelerate our product roadmap and our expansion in both in Europe and in Asia as well, because we continue to grow in Asia.
Yeah, and what kind of valuation did the company achieve with your last raise?
So that's a tough one. Not yet a unicorn, but so I can't really disclose the numbers, but we are working hard on making the valuation interesting for our investors. But our prime driver is really client satisfaction, building the revenue model, because this is fairly new for the industry as well. There is no real benchmark. So we tend not to focus too much on fundraising and valuations, but more on growing the company sustainably, I would say, because the pace of building innovation in capital markets is different from traditional B2B or B2C markets.
I know it's early days. The company's only about 3 years old, and you have a lot of work ahead of you, but what do you think is the exit for you? What's the ultimate goal that you hope to achieve at some point?
There is no real limit about, I mean, the TAM, the total addressable market is quite huge. We believe it's roughly $500 million or above. There are lots of things to be done, not only in distribution, but in origination, in post-trade services, in data. So we really want to expand first geographically. So we want to be a global player and one of the only global players in the loan space, and partner with our existing investors which are in the industry, and some partners as well on the industrial front. So we have not really any exits in mind at this stage. It's really still a bit early to say. I would like to build a company with my team which is different. That's my second venture. The first one was successful, and I think we really want to put the focus on our clients and our people first.
Great. Well, Bertrand, thank you so much for joining me today on DigFin VOX.
Thanks, Jame, and looking forward to next conversation. Thanks a lot.
Okay.